Most people who buy term insurance spend a lot of time thinking about which plan to buy, how much cover to get, and which insurer to trust. What very few people think about is what happens after. Specifically, what happens when the policy actually needs to do its job. How does the money reach your family? Who receives it? Can they choose how it comes to them? As a lump sum or spread over monthly payments? How long does the process take? And what do they need to do make it happen? These are not complicated questions, but they are questions most nominees have never been given clear answers to. And in a moment when your family is already dealing with a great deal, not knowing the answers adds unnecessary stress to an already difficult time. This video is about removing that uncertainty completely. By the end of it, you will know exactly how a term insurance payout works, step by step, what your family needs to do, and what the law guarantees them along the way. Before we get into the process, let us be clear about what a term insurance payout actually is, because there is a common misconception worth clearing up early. A term insurance payout is the amount the insurer pays to your nominee when a valid claim is filed. It is the coverage amount you chose when you bought the policy, paid out to the person you named to receive it. It's not actually a maturity benefit, and it is not a return on investment. It is a protection benefit, and it kicks in specifically when the policy needs to do its job. It is actually worth knowing who actually receives this money. The payout goes to the nominee you named in your policy. This could be your spouse or parent, a child, or any other family member you chose. If no nominee is named or the nominee is no longer alive, the payout goes to your legal heir. Though that process takes a little longer and requires some additional paperwork, this is one of the most important reasons to keep your nominee details updated as your life changes. One more thing worth knowing. The money your family receives on account of death is completely tax-free. Every rupee of it, whether the payout is 25 lakhs or 2 crores, comes to them without any deductions. That is the law under Section 11, read with Schedule 2 of the Income Tax Act 2025, previously Section 1010D. Now, most people assume that when a term insurance claim is paid out, it comes as one large lump sum straight to the nominee's account. And that is one way it can work. But what a lot of people do not realize is that you actually get to choose how the money comes to your family. And depending on your family situation, that choice can make a big difference. There are 4 options you can pick from. The first is lump sum. The entire amount lands in your nominee's account at once. This works well if your family would want to clear a home loan immediately, settle any outstanding debts, or simply invest the money and manage it themselves. The second is a monthly income. Instead of one large amount, the insurer pays out a fixed amount every month for a set number of years. For families that are more used to managing a monthly budget than handling a large sum all at once, this one often feels more practical. The third option is a mix of both. A portion comes immediately as a lump sum, and the rest is paid out monthly over time. So if there is a loan to clear right away, but the family also needs a steady income to cover everyday expenses, this option handles both at the same time. The fourth is an increasing monthly income, where the monthly payout grows a little each year to keep up with rising costs. This one is worth considering for younger families, because what feels like a comfortable amount today may not stretch as far 10 years from now. The option you pick when you buy the policy shapes how your family actually experiences that financial support when they need it most. So, it is worth thinking about which one matches how they really manage money, not just which one sounds the best on paper. Here is exactly what happens between the moment a claim needs to be filed and the moment the money reaches your family's account. Step 1 is claim intimation. The nominee contacts the insurer to inform that a claim needs to be filed. This can be done online through the insurer's website, through a customer helpline, or by visiting a branch in person. At this stage, the nominee provides the policy number, the date of the event, and the cause. This is the first step, and it opens the claim formally. Step 2 is document submission. The nominee submits the required documents to the insurer. This typically includes the original policy document, a death certificate, identity and address proof of the nominee's bank account details, and medical or hospital records if relevant. The insurer will specify exactly what is needed based on the circumstances of the claim. Step 3 is verification by the insurer. The insurer reviews the submitted documents, confirms that the policy was active and premiums were paid up to date, and verifies that the cause is covered under the policy terms. For straightforward claims, this step moves quickly. For claims involving accidental or overseas circumstances, additional verification may be required. Step 4 is claim approval. Once all documentation has been reviewed and verified, the insurer formally approves the claim. Step 5 is the payout transfer. The approved payout amount, whether lump sum, monthly income, or a combination, is transferred directly to the nominee's registered bank account through NEFT or RTGS. No cash payments are made. Step 6 is the tax treatment. The payout received by the nominee is fully exempt from income tax under Section 11, read with Schedule 2 of the Income Tax Act 2025. Previously, Section 1010D. The family receives the full amount without any deductions. This is the part most people do not know, and it is one of the most reassuring facts about term insurance in India. The Insurance Regulatory and Development Authority of India, IRDAI, has set legally binding timelines for claim settlement. Insurers are not free to take as long as they want. For straightforward claims where all documents are in order, the insurer must settle the claim within 15 days of receiving the complete set of documents. That is the legal maximum for simple, valid claim. For cases where the insurer needs to conduct further investigation, perhaps for an accidental death or a claim involving overseas circumstances, the investigation must be completed and the claim resolved within 45 days of receiving the documents. And if an insurer delays beyond these timelines without justification, they are required to pay interest on the claim amount to the nominee for the period of delay. The law is firmly on the side of your family. This is why understanding the claim process matters so much. When your family knows exactly what documents to submit and submits them completely and correctly the first time, the clock starts immediately and the 15-day window is triggered. Delay on the family side is usually the only thing that extends the timeline beyond what the law requires. This is the question that sits quietly in the back of every policyholder's mind. I have been paying premiums for years, but will my family actually get the money? The honest answer is yes, provided 3 conditions are met. The policy must be active, which means premiums have been paid on time. You must have disclosed your health, lifestyle, and financial details truthfully when you bought the policy. And the claim must not involve fraud or deliberate misrepresentation. When those conditions are met, a term insurance claim is protected by the law. The insurer cannot reject it arbitrarily. And there is an additional layer of protection that strengthens this guarantee significantly. It is called Section 45 of the Insurers Act 1938, amended in 2015. And it is one of the most important consumer protection provisions in Indian insurance law. Section 45 states that once a policy has been forced for 3 continuous years, no insurer can reject a claim on the grounds of misrepresentation or omission unless it can prove intentional fraud. After that 3-year mark, even if there was a minor error or an unintentional omission in the original application, the claim cannot be denied on those grounds. The burden of proving fraud lies with the insurer, not the nominee. What causes claims to be rejected? In the rare cases where they are. The most common reasons are non-disclosure of health conditions such as diabetes, hypertension, or smoking habits at the time of purchase, a lapsed policy due to missed premium payments, outdated or incorrect nominee details, or deliberate misrepresentation of income or occupation on the proposal form. Every one of these is preventable. And every one of them comes back to the same principle. Honesty at the time of purchase and discipline in maintaining the policy afterward are what make the guarantee real. Here is a simple checklist. These are the actions that sit between you and a smooth, fast payout for your family. First, make sure your proposal form was filled with complete and honest disclosure. Health conditions, smoking habits, existing policies, occupation, income, everything. If anything was left out when you bought the policy, speak to your insurer about how to address it. Second, keep your policy active. Set up an auto debit mandate for your premium payments so the policy never lapses due to a missed payment. Third, update your nominee details whenever your family situation changes. Marriage, a new child, the passing of an existing nominee, a simple update today prevents significant complications later. Fourth, tell your family. Your spouse, your nominee, or a trusted family member should know the insurer's name, your policy number, and where the documents are stored. This one conversation could save weeks of confusion. Fifth, store your policy documents safely and share a soft copy with your nominee. When the time comes, having the documents ready and accessible is the single fastest way to trigger the 15-day settlement window. ABSLI's claim settlement process is built around one principle. Every genuine claim is a promise kept. And the numbers back that up. In the financial year 2025-26, ABSLI settled 98.86% of all individual life insurance claims. That means out of every 100 families that filed a claim, nearly 99 received their payout. For group insurance, the settlement ratio was even higher, at 99.75%. These figures are based on the company's latest disclosures. IRDAI publishes industry data with a standard time lag, which is why the most recent performance may not show up there. But the number that matters most for your family is the turnaround time. Once all documents are submitted, ABSLI's average individual claim settlement time is 1 working days. Not 30 days, not 180 days, 1 working day. ABSLI provides online claim intimation through its official website, a dedicated claim support team that guides nominees through every step, and transparent communication from the moment a claim is received to the moment the money reaches the account. ABSLI complies fully with IRDAI settlement timelines, and its consistently high claim settlement ratio reflects the reliability of that commitment. If you are an existing ABSLI policyholder, the link to initiate a claim online is in the description below. If you're still looking for a term plan that gives your family this kind of protection and clarity, the ABSLI Super Term Plan and DigiShield Plan are both linked below, along with a calculator that gives you your personalized premium in 2 minutes. Quick answers to the FAQs we get asked the most. How does term insurance payout work after death in India? And how long does it actually take? Once the nominee submits all required documents, death certificate, policy document, ID proof, and bank details, IRDAI regulations require the insurers to settle the claim within 15 days for cases that do not require further investigation, and 45 days for cases requiring investigation, and the money is transferred directly to nominee's bank account. The timeline starts from the date all documents are received by the insurer, not the date of death. Is a term insurance payout guaranteed in India? Can the insurer refuse to pay? A term insurance claim can only be rejected on specific legal grounds. Most commonly, non-disclosure of a material fact at the time of purchase, such as pre-existing health condition or a policy that has lapsed due to unpaid premiums. Section 45 of the Insurers Act also protects policyholders after 3 years. An insurer cannot reject a claim on the grounds of misrepresentation unless fraud is proven. If your policy is active and your disclosure were honest, the payout is effectively guaranteed. If this video helped you understand how the claim process works, share it with one person in your family who is named as a nominee on any term insurance policy. That one share might be the most useful thing you do for them today. Hit like and subscribe for more videos in this series.